Hey guys, welcome back to another episode. In this video we will be going through our engulfing trading strategy in depth and how we use it in combination with price action. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. The engulfing trading strategy will give you the skills you need to become a better trader. Through this guide, I am going to take a deeper look into what exactly is the engulfing pattern and how understanding this particular pattern can improve your outcomes as a trader. Furthermore, I am going to show you how to master the engulfing bar trading strategy with a simple twist. Don't worry if you already know how engulfing trading works, we have some additional information for you as well. This will strengthen your existing knowledge about the engulfing candle trading strategy and help you find new opportunities to succeed as a trader. Now, what is the engulfing pattern? Engulfing candles tend to signal a reversal of the current trend in the market. This specific pattern involves two candles with the latter candle engulfs the entire body of the candle before it. Although an engulfing bar is technically valid if it engulfs just the immediate bar prior to it. Note that the more prior bars that this bar engulfs, the stronger it gets. Types of engulfing patterns. There are two engulfing candle patterns. Bullish engulfing and the bearish engulfing pattern. First, bullish engulfing pattern. The pattern involves two candles with the second candle completely engulfing the body of the previous down candle. Interpretation. Price action must show a clear downtrend when the bullish pattern appears. The large bullish candle shows that buyers are piling into the market aggressively, and this provides the initial bias for further upward momentum. Traders will then look for confirmation that the trend is indeed turning around by making use of indicators, key levels of support and resistance, and subsequent price action after the engulfing pattern. Second, bearish engulfing pattern. The bearish engulfing pattern is simply the opposite of the bullish pattern. The bearish engulfing candle often triggers a reversal of an existing trend as more sellers enter the market and drive prices down further. The pattern involves two candles with the second down candle completely engulfing the body of the previous up candle. Interpretation. Price action must show a clear uptrend when the bearish pattern appears. The large bearish candle shows that sellers are piling into the market aggressively, and this provides the initial bias for further downward momentum. Traders will then look for confirmation that the trend is indeed turning around by making use of indicators, levels of support and resistance, and subsequent price action that occurs after the engulfing pattern. And now, how to trade engulfing pattern. Engulfing candles don't always have to appear at the end of a trend. When viewed within a strong trend, traders can glean information from the candle pattern, pointing towards continued momentum in the direction of the existing trend. In this video, I will give you an easy 4-step process to trade engulfing pattern. So, let's get started. Step 1. Isolate the trend. The first step in applying the engulfing candle trading strategy is to determine the dominant trend direction, and thus the direction you will trade in. An uptrend is defined by higher swinging highs and higher swinging lows in price. Prices move in waves, advancing, pulling back, and then advancing again. In an uptrend, the advancing waves are larger than the pullbacks lower, creating overall progress higher. During an uptrend, you should take only long positions, buying with the intention of selling later at a higher price. A downtrend is defined by lower swinging lows and lower swinging highs in price. In a downtrend, the declining waves are larger than the pullbacks higher, creating overall progress lower. During a downtrend, you should take only short positions, selling a borrowed asset with the intention of buying and returning it later at a lower price. Step 2. Watch for an upward or downward pullback. Once the trend is established, wait for a pullback. If there is no trend or it is unclear, don't utilize this strategy. Waiting for a pullback means you're getting advantageous pricing for the next wave of the trend when and if it unfolds. If the trend is down, watch for an upward pullback. The pullback should not rally above the high of the prior pullback, as this violates the rules of a downtrend. And if the trend is up, watch for a downward pullback. The pullback should not drop below the low of the prior pullback, as this violates the rules of an uptrend. A pullback should be composed of at least two price movements, indicating the price has actually corrected. Pullbacks may move in the opposite direction of the trend or may just move sideways. Step 3. Entering the trade. With the trend isolated and a pullback occurring, wait for the engulfing candle strategy trade signal. During a downtrend, wait until a down candle engulfs an up candle. For an engulfing candle strategy signal during an uptrend, wait until an up candle engulfs a down candle. The most practical and widely used way to trade these bars is to simply place a pending entry order a few pips above the high of a bullish engulfing bar and a few pips below the low of a bearish engulfing bar. Once a trade is initiated using the engulfing candle strategy, the safest position for a stop loss is a few pips above the recent swing high for short positions and below the recent swing low for long positions. Step 4. Exiting the trade. The engulfing candle that occurs after a pullback in an overall trend is designed to get you into a trade as the next wave of the trend is likely to unfold. But, however, it doesn't always. Trends can persist for a long time or can fail quickly. Therefore, this method does not have a specific exit. A rule of thumb is to make sure your winners are at least 2 times as big as your losers, 5 times bigger is even better. Therefore, measure the distance between your entry point and where you place the stop loss. For example, if it is 40 cents, that is your risk. Your target price should be at least 2 times greater than that, or 80 cents. Therefore, hold the trade for at least a 80-cent gain to compensate yourself for the risk you've taken. If the trend threatens to reverse by making a higher high and higher low during a downtrend and short trade, or by making a lower high and lower low during an uptrend and long trade, exit the trade. Cautionary notes. First, the sign that trading the engulfing pattern is a bad idea was that we didn't have enough profit margins. Here is the example. Second, engulfing patterns won't occur after every pullback, which means potentially missed opportunities. To help avoid this, consider allowing multiple candles to create an engulfing pattern. For example, if after a pullback in an uptrend, it takes 2 up candles to engulf the prior down candle, consider this a valid signal of a shift in momentum back in the trending direction. Third, an engulfing candle strategy signal doesn't mean the trend will always resume. That is why a stop loss is mandatory. As always, if you learned something new, make sure you subscribe, click the notification bell and leave us a like to show your support. See you next time.